Hi, everyone. Today we'll be presenting an analysis of Dollar General's strategic position and its competitive advantage. We'll start by explaining the external factors that impact Dollar General, focusing on frameworks like Porter's Five Forces and the VRIO framework. We will also look at how the company is positioned in the market and how it manages to maintain its competitive advantage. Our analysis will cover both internal and external perspectives, as well as the broader social and cultural environment in which the company operates.
Thanks. Porter's Five Forces is a helpful framework to analyze the competitive pressures Dollar General faces. The first force is risk of new entrants. The risk is low. The discount retail market is highly competitive and requires substantial capital to establish a network of stores and distribution channels. Dollar General has already built strong brand loyalty, making it hard for new entrants to compete. Additionally, Dollar General's locations are chosen for their convenience, especially in rural areas where competition is limited. Second of the five forces is market power of buyers. Buyer power is moderate. While there are many alternatives like Walmart, Target, and online retailers, Dollar General focuses on accessibility and convenience, especially in underserved and rural areas. In these areas, customers are often limited to local options, reducing their bargaining power. The third of the five powers is the market power of sellers. Dollar General has significant power over its suppliers. By working with numerous suppliers and focusing on low-cost products, Dollar General can switch suppliers if necessary. This reduces supplier dependence and helps Dollar General negotiate better prices, making the overall risk moderate. The fourth power is risk of substitution. Substitutes do not exist in the form of larger retailer chains, local stores, and online shopping. However, Dollar General's strategic focus on affordability and its presence in areas where alternatives are limited makes this threat moderate. The fifth and final force is rivalry between competitors. Rivalry is high. Dollar General faces competition from large retailers like Walmart and Target. However, its small format stores, particularly in rural and underserved areas, give it a unique advantage by reducing direct competition from larger retail chains. This allows Dollar General to carve out a niche in regions that other companies neglect. This competitive environment sets the stage for understanding how Dollar General can sustain its position through its resources and capabilities. That brings us to the VRIO framework.
Thanks. Now let's dive into the VRIO framework, which helps evaluate Dollar General's internal resources and capabilities. Firstly, value. Dollar General's value lies in its cost-efficient operations, strategic store locations, and brand recognition. Its ability to keep costs low and pass those savings on to customers is a significant advantage. The brand loyalty it has built over time also adds value, especially among price-sensitive consumers. Secondly, rare. Dollar General store locations in rural and underserved areas are rare. These locations are not typically prioritized by larger retailers, giving Dollar General a competitive edge. Its low-cost business model, which allows it to compete against big players, is also relatively rare. Next, inimitable. Dollar General's supply chain and distribution network are difficult to imitate. The company's geographic focus on rural areas and the efficiency of its operations give it a competitive advantage that isn't easily replicated by competitors. Lastly, organized. Dollar General is well organized with an efficient supply chain, effective store management, and a successful franchise model. This organization allows it to operate efficiently, offering low prices while maintaining a strong presence in key locations. These resources give Dollar General a strong internal position, but how does it perform in the changing social and cultural environment? Let's take a look at how the company must adapt to shifting consumer values and CSR expectations.
I'm Xinyun. Let's begin by looking at the key external threats Dollar General faces. First, competition from e-commerce giants like Amazon and Walmart is rising. Faster delivery, and competitive pricing now reach even rural markets, which is to be Dollar General's stronghold. Second, consumer expectations are evolving. People want transparency in sourcing, fair labor, and environmental responsibility, even in price-sensitive communities. Third, regulatory and institutional pressures are increasing. New labor source laws, sustainability mandates, and reporting standards could raise cost significantly. And finally, there is a cultural shift. Ethical business practices are becoming a basic expectation. To stay relevant, Dollar General must adapt, not just to survive, but to grow. To understand how Dollar General can respond, we use two frameworks: institutional theory and corporate social responsibility. They help us analyze how social norms and expectations shape strategy and how companies like Dollar General can align with them to remain legitimate and competitive. And institutional theory tells us that companies need to conform to societal expectations or risk losing their legitimacy. Today's consumers demand transparency, sustainability, and ethical practices. Dollar General can respond by expanding eco-friendly product lines and improving supply chain transparency. At the same time, demographic shifts are reshaping the market as rural populations decline and urban poverty rises. Dollar General has the opportunity to open stores in underserved urban areas and offer more culturally relevant products. Corporate social responsibility is now essential. There is pressure to uphold fair labor, responsible sourcing, and community involvement. If Dollar General proactively embraces CSR, it can build not just legitimacy, but a stronger comparative position by becoming a brand people trust and support. Sustainability is a growing priority. Recycling programs, reduced packaging, and responsible sourcing will improve public perception while still supporting the low-cost model. Internally, fair labor practices like improving wages, working conditions, and training can reduce turnover and improve service. Treating employees well leads to better morale and long-term stability. Dollar General can also strengthen its role in rural and urban communities by investing in local development and charitable programs. Community engagement creates emotional loyalty and reinforces the brand's presence as more than just a store. It becomes a neighborhood partner. So what does this all mean? A strong CSR strategy boosts brand loyalty, employee retention, and public trust. It helps Dollar General stand out not just on price but on purpose. And in a world of rising scrutiny and shifting norms, that may be the most valuable competitive edge of all.
To conclude, Dollar General's strategic position is strong due to its cost leadership strategy, efficient supply chain, and focus on underserved markets. These factors give the company a solid foundation in a competitive retail environment. However, Dollar General must continue to adapt to the changing social and cultural landscape, particularly in terms of sustainability and CSR. Moving into the future, we have some insights that Dollar General will need to analyze in order to maintain their competitive advantage in the market. Like many companies, Dollar General was faced with many hardships during the COVID-19 pandemic, such as supply chain disruptions and rising input costs. However, they were able to succeed as many customers turned to discount retailers like Dollar General for essential goods at affordable prices. With many people losing jobs or facing financial uncertainty, the demand for low-cost groceries, cleaning supplies, and health-related items spiked. At this point in time, it appears that Dollar General will have the opportunity to capitalize on the projections of rising costs of living and an increasing demand for lower prices. This can be attributed to increasing inflation, some still in part to fallout from the pandemic, as well as the global tariffs put in place by the current United States government. In combination, it is projected that the United States is heading towards a potential recession in which costs of living is expected to rise along with unemployment, meaning there will be a larger consumer base in demand for the more affordable prices that Dollar General will be able to provide. The current stock market in the United States has been incredibly volatile since the inauguration of the current president, Donald Trump. This is largely in part due to the economic uncertainty related to tariff threats and plummeting consumer confidence. Despite economic indicators such as the DOW and S&P 500 having their biggest two-day loss in stock market history, Dollar General appears to be performing rather well. Dollar General has been one of the strongest performing stocks in Russell 1000, which measures the 1,000 most valuable stocks since the inauguration day. This is an indication that the average investor expects Dollar General to continue making profits by being able to use of its unique competitive advantage. Dollar General should evaluate whether they expect the tariffs to remain in place and the cost of living to continue to rise for the foreseeable future. If they have the opportunity to further capitalize on this opportunity, it is then recommended that they expand their operations by opening more locations, particularly in lower income areas of the country, as they have done in the past. In addition, Dollar General can make their services more accessible to rural areas by further developing their delivery services. They have previously worked with DoorDash in limited locations, and so expanding these services to more of these locations would likely prove beneficial. By adapting to evolving institutional environment and staying ahead of emerging customer trends, Dollar General can not only maintain its competitive advantage, but also strengthen its position for future growth. Thank you for listening to our analysis. We're happy to take any questions.